Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shad here, your host for this weekend show. This weekend show very much focused on the commodity sectors. First half of the show, we're going to be focusing on opportunities in more the metals areas. And back half of the show, we're going to look to the energy sectors, oil and natural gas, which with how well metals and metal stocks are doing, boy, oh boy, the oil and natural gas sectors have been pretty boring. Lack of price movements on the commodity price front, and the stocks, you can still find individual stories, but you need to be a lot more selective in that energy sector. Just as a note, please go back through our website, kereport.com, or podcast. On your podcast player, just search the KE Report. You can also find us on YouTube and Substack by searching the KE Report to listen to all our daily editorials and company updates. Without further ado, let's get into this weekend show as we're chatting with Matt Geiger. Matt is the managing partner at MJG Capital. We both got to see you down at the Beaver Creek conference, Matt. We shared our thoughts on that conference the week after. We've had some other commentators share their thoughts, and quite frankly, across the board, everyone was just outlining how enthusiastic, how bullish that environment was. Curious what you saw in terms of sentiment at that conference.
Well, first, Corey, I'll say it was great grabbing a beer and actually spending some time in person. We had Trevor Hall and a couple other folks join us. I really enjoyed that, and it's always more fun to spend time in person, versus discussing things over the phone or over Zoom as we do so often. So that's one of the reasons I really value these conferences. In terms of the sentiment and what I saw at Beaver Creek, I only started attending Beaver Creek in 2019. To be clear. So I can't claim to have attended every one of these conferences going back to its inception a little bit over a decade ago. But what I can say is that the mood was more upbeat and optimistic than at any of the Beaver Creeks that I've attended previously. From a numbers perspective, I saw some figures from Paul Harris. The number of companies participating jumped 38% from the previous year. And on the investor side, the number of participants was roughly 20% higher than it was in 2024. So pretty marked increases on both fronts. But I should note this doesn't account for the number of industry participants that are hanging around the conference and not participating formally, but are there at the bar and grill and participating in meetings off the books. And I can say that the numbers were markedly higher of folks that fall into that category relative to what we've seen in the most recent years. So it is certainly exciting to see energy returning to this sector, and there was plenty of energy at the conference, but it does make the contrarian side of me somewhat nervous. But when I say this, I did not witness the type of enthusiasm one would expect to see at the very peak of a secular bull market. We didn't see that level of exuberance, but what I did see indicated to me that a pullback or at least some consolidation is very likely in order, particularly as it pertains to gold, silver, and the associated mining equities.
Well, Matt, with that frame of mind and the bullishness that you saw in the precious metals, where do you think the best opportunities are today? Because a lot of these stocks have run 1x, 2x, 3x. So you can understand why people at Beaver Creek were pretty excited. You can understand where the enthusiasm's coming from. Everybody feels smart in a bull market. And as our friend Rick Rule always says, we don't want to confuse a bull market with brains. But at this point, it's getting harder to find the opportunities in the gold and silver space. So where do you see the opportunities there, or have the opportunities shifted into other commodities?
Well, I think it's very important to draw a distinction between gold and silver and really the rest of the metals complex. And I would argue gold and silver are more advanced in their cycles. As a very imperfect yardstick, the price of physical gold advanced roughly 7 times between the trough in the early 2000s and the peak of that bull market in 2011. So were this cycle to play out exactly the same way, which to be very clear, it won't, but this is just a rough yardstick. Were this cycle to play out the very same way, we'd be almost exactly 50% through this move, given that gold is up 3.5 times from its late 2015 lows. And I think silver perking up quite noticeably in the past 60 days or so signals, to me at least, is another data point that we're in the middle innings of this move in precious metals. So I think in terms of where we go next, I think we see the baton handed off to copper in pretty short order here. I'll point to the copper gold ratio, which is now lower than it was during the depths of the COVID panic in spring of 2020, which is pretty shocking. And I think that's unsustainable over any reasonable period of time. We've also seen a number of supply disruptions in recent weeks. Actually, just today, we saw force majeure declared at Grasberg, which is the world's second largest copper mine, after a landslide killed 2 employees with five more missing. So I send prayers to the missing employees and hope that they're found safely. And it's also been reported that there's been damage sustained to key infrastructure at Grasberg. So that's a huge deal. And then just earlier this week, we saw operations pause at Constancia in Peru. That's Hudbay Minerals, due to social unrest near the mine. And this is all on top of the tunnel collapse at El Teniente last month, which has seen a decent percentage of that mine's production put offline for the indefinite future. So I think copper should be in store for a little bit of a run here between these snowballing supply disruptions and also its historical cheapness relative to gold. And I should note, it's cheaper than it was during the depths of the COVID pandemic liquidation. I think if you look back all the way to 1980, we haven't seen copper as cheap as it is relative to gold right now. So the stage is set. With all that said, I should note that the MJG partnership has its highest weighting towards copper-focused companies, at roughly 45% of our overall portfolio. So I think it's good to acknowledge that this may be coloring my perspective somewhat as I make these points.
Hey, no problem with talking your own book there, Matt, but I do want to dive a little bit more into that then. Since you want to talk your book, or since you mentioned it, what stage of copper companies are you looking at? Because there are a handful, I would say, that seem to be ready to be built, but those price tags or permitting are still, I guess, in a way, delaying those from being built. There's a ton of explorers out there, but it costs so much money to explore for large copper systems. We keep hearing from these juniors that they're always looking for partners, and some of these partnerships have been slow to come by. So where have you been focusing the portfolio?
Early stage. Yeah, very early stage, in short. We do have some royalty exposure to copper via Altus Minerals, as well as Elemental, which are 2 companies I've written about in recent MJG partnership letters. But I actually don't consider either of them copper-focused companies per se. In terms of our copper-focused names, we have a couple developers. 2 that I've also written about in recent MJG letters include Lara Exploration and their development stage Planalto project down in Brazil, and then Corex Copper and its Habe project in Namibia, where we just saw a PEA come out a few weeks ago. And then other than that, all our copper exposure comes through either primarily through prospect generators and then in a couple exploration stage names. So we're definitely down cap as it pertains to copper. But I think that should serve us quite well because in a general sense, we are seeing money come down cap into exploration stage names. I would pinpoint kind of late April to early May is when we started to see that phenomenon take place. And it's really only accelerated in the following months.
Well, we'll definitely keep tabs on the copper sector across all stages, the exploration, development, and production. And there's still a lot of opportunity to rotate some precious metals funds into the copper space for the longer bull cycle it has. But like you say, there's really a distinction between the precious metals and the rest of the commodities. But you did bring up some of the royalty companies in that answer on copper. And when you mentioned the copper exposure you have through Elemental Altus, it made me think of what we just saw in Beaver Creek, Matt, where right before the conference, the big news dropped about the merger of Elemental Altus Royalties with EMX Royalty Corp to form a new pro forma mid-tier company in the space. We've interviewed the company this week, and we've had some other people weigh in on it, but I'd love to get your thoughts on what this means for the sector to have these 2 companies come together, but also weave in the angle of the Tether investment angle with Elemental Altus and how the crypto money has found the precious metal sector.
Sure, I'd be happy to. In terms of the deal itself, look, I'm quite constructive on the deal. And honestly, I wanted to see Elemental and EMX join forces years ago. I think it's okay to say this now that the dust has settled, but these are two teams that have been, in on and off M&A discussions for a couple years now. And honestly, I became a bit jaded when I didn't see a deal come to fruition previously. So it was a very positive surprise to see that the news hit the wire just shortly before the Beaver Creek conference. And I do think Tether's involvement, ultimately made all the difference in getting this deal across the finish line. In terms of the aspects of the deal that I like, the first point I'll make is that these two teams are very familiar with each other at this point. I mentioned the ongoing M&A discussions that finally came to fruition, but also remember that they syndicated the Caserones royalty together back in 2021. And it's my understanding that they worked very hard and got very close to syndicating another royalty deal in the following years. So these are two groups that know each other very well. There's also the overlap of key royalties, with Caserones being the key one, and that will be a flagship for the combined companies going forward, but also Arizona Sonoran's Cactus project. And perhaps more importantly, from an overlap perspective, there's the overlap in the company's shareholder bases with, investors like Paul Stevens, Adrian Day, Darren Millmeister at Extract Capital coming to mind as long-term supporters of both of these companies. And finally, I do like that the combined company will continue with EMX's royalty generation business at its current run rate. So I do think this is a very nice differentiator over most all of the company's peer group, with the exceptions of Altius and Origin. So a lot to like about the deal. I will say there are a couple aspects that I didn't like. The first is that Tether conducted a concurrent $100 million financing at a 10% discount to Elemental's closing price on the deal on the day that the deal was announced. Tether will argue that even considering this discount, this money came at a lower cost of capital than if Elemental had gone to the banks and raised a similar amount of capital. And, while I think that's probably true, I think it would have gone a long way for Tether to have either opened this financing up to existing Elemental shareholders to participate as well, or just have done the deal at Elemental's closing price on the day the deal was announced. So one nitpick there. And then another point, I think it is a big loss that Sandeep Singh will not be serving on the combined company's boards. He has deep experience in the royalty space between his time as CEO of Osisko Royalties and also his time as a banker. So I was disappointed to not see him included on the combined board going forward. But, with all that said, well, it's not a perfect deal from my perspective. I do think the pros very much outweigh the cons. And, from a general sense, as a close follower of the royalty space, it's exciting to me to see one less name on the board as we look to the junior names.
Yeah, I love this scaling up, but to the point of what the strategy is going to be with EMX and Elemental taking, in a way, different tacks to generate royalties with Tether in the game, do you expect this combined company to be a whole lot more aggressive now that it seems like they have just different funding options available to them?
Sure. I mean, I know Tether is pedal to the metal. They want to grow aggressively. And I will say it's incumbent on Dave Cole, Fred, Dave Baker, Stefan Wenger, who will be the combined company's CFO, to push back on Tether when necessary. I think this company is going to grow. It's going to be aggressive, but it needs to be the right deals at the right price. So as a shareholder of the combined company, I'll be tracking each and every one of their deals closely to make sure that they're remaining disciplined. With that said, I think there's tremendous opportunity here. With this merger, this makes Elemental now one of three companies in kind of the $1 to $10 billion snack bracket in terms of precious metal focused royalty companies. And the other two are Triple Flag and OR. And as I think we've discussed previously, I still think there is a decent chance that we do ultimately see a merger between OR and Triple Flag. And, thinking ahead, were this to be the case, that would leave Elemental as the only precious metal focused royalty company in that US, $1 to $10 billion snack bracket. So I think that will provide them with an interesting niche in which to grow their business. But it's clear that Tether will be there for support. And I think it's also more clear, what Tether's ultimate strategy is here. When Tether announced the Elemental deal initially, there are a whole bunch of different routes they could have gone down. The acquisition of that controlling stake could have been a means to taking over Elemental entirely. That does not seem to be the direction they're going. It could have been a sign that Tether was going to go out and acquire more controlling stakes in other junior royalty peers. That does not appear to be the path that they're going. There was some discussion of Tether maybe syndicating royalties with Elemental so that they could own them outright. That does not seem to be the direction they're going. And I wrote about this in the most recent MJG investor letter, and my conclusion is that they were going to do largely what they're doing now, which is use Elemental as their growth vehicle in the royalty space to both opportunistically acquire peers and when value is not on offer to evaluate individual royalty and streaming purchases as they come up.
Yeah, man, I think you're spot on there. And again, in talking with the company, both at Beaver Creek and just even recently this week on our show, they made that point again that, it doesn't seem that Tether has any interest in just taking them over. That would stop the new deal flow. And it doesn't seem any interest in doing their own syndication of deals. They really want to use this vehicle, the new combined pro forma Elemental Royalty Corp is what it'll be called, to go out and make acquisitions and grow the company that way. But it does you brought up a great point about them being really the only company that'll be left in the mid-tier snack bracket, especially the smaller mid-tier. And I guess you and I feel a little differently about the less names on the boards. I actually like seeing the choice and the different styles of royalty companies, but there are probably a dozen sub $1 billion junior companies. So it is nice to see this middle of the road company. Do you think that gives them more optionality around doing deals that are maybe too small for the big guys, but too big for the little guys? Does it give them a unique edge to do kind of mid-tier size deals?
Well, just to put a pin in your previous point, we have had this discussion, this friendly disagreement before. And the reason why I think less is more in terms of the junior royalty names is, look, this is a very, very competitive industry at this point. And it's competitive on a couple fronts. First, on finding actual deals in which to grow. And secondly, in terms of cost of capital, which can be lessened by attracting investors, raising your share price, and you can justify paying higher valuations for deals that you wouldn't be able to do otherwise. So from my perspective, the less names that are on the board, the less competition there is for deals, and the less competition there is for investor eyeballs. So that's why I'm pretty steadfast on this point. As we look to the combined Elemental and EMX, just on the cost of capital front, we're looking at a near-term listing here in the U.S., most likely on the NASDAQ. So that's going to result in indexation. So we should see some passive inflows into the stock through that. And I think given their size, it's quite likely, speaking this time next year, that we'll see Elemental included on both the GDXJ and the GDX. So that could be some additional passive inflows coming its way. But, to your point, both companies have re-rated on the back of this acquisition, but we're still, only looking at a combined company worth over $1 billion US and change. So they can afford to look at some of the smaller deals that will still move the needle for them, relative to certainly a Franco or a Wheaton, but even to a triple flag or an OR. So I think for the time being, they occupy a pretty interesting niche. And to that capital point, they're going to be able to afford to pay a little bit more for potential acquisitions than, the Metallas or the Groys of the world that may be looking at similar deals.
That's such a key distinction right there is again, access to capital, their ability to make deals. Look, that merger taken very positively by the market. Let's also step back to more touching on some of these major companies or larger companies taking stakes in juniors through either exploration or looking at helping to develop some of their projects. You brought up Centerra Gold and their recent stake in Liberty Gold. Look, Centerra is actually in a few companies in terms of helping to fund exploration, really using these other companies maybe as a bit of a exploration wing. What's your take on Centerra Gold, even the bigger picture, some of these larger companies dabbling in the junior space, mostly through equity investments?
Yeah, I mean, I've been following Centerra's moves very closely here over the past 18 months. From a high level perspective, I think this has been a very shrewd strategy from Centerra. Really, since the Kennerland investment in early 2024, they've proactively gone out and taken strategic equity stakes in a number of well-run juniors. Kennerland was the first. That was followed by Headwater Gold. That was followed by Azimut and Midland up in Quebec, Dryden Gold. And then most recently, during the Beaver Creek conference, they announced a strategic investment in Liberty Gold. So with the exception of Liberty, which I think should fairly be characterized as a later stage developer, each of these companies are either a prospect generator or in the case of Dryden, an early stage explorer. And this makes me think of Neil Adshed's recent post on LinkedIn, where he showed that of the 30 major precious metal miners in North America, they're returning nearly 6 times more to shareholders via either dividends or share buybacks versus what they're dedicating to exploration spend. So I think in this respect, Centerra is really zigging while its peers are zagging, as Centerra doubles down on early stage exploration. And I ultimately think it's going to serve the company well by establishing these relations with well-run early stage exploration groups, before their peers try to do the same. Because I do think as the cycle advances, we're going to see this, 6x ratio that Neil points to come down as some of Centerra's or most of Centerra's peers follow its playbook. And I should also note this has been very relevant, to the MJG partnership, as we've been, long-term shareholders of Kennerland and are now co-invested with Centerra there. And we're also recent shareholders of Headwater Gold through their most recent private placement, where Centerra followed their check and topped up their 9.9% strategic stake there. We're also invested in Scout Discoveries, which announced a project level deal. So to be clear, this was not an equity stake, but a project level deal with Centerra at Scout's Lehman Butte project in Idaho. But I think even for those that are not, directly invested alongside Centerra, for those that are interested in early stage exploration, particularly in North America, where all of these deals have taken place, I think it would be smart for investors to follow Centerra's moves very closely, because I think we have more to come.
Yeah, man, I think it's an interesting point that they're zigging when others zag, and that they are really investing in the early stage of the cycle, the exploration, the prospect generation side, as well as the development stage, Liberty, but still has exploration on its cards as well. But there's the argument that some people make that it's better to see people come in at a project level basis or a company level basis, or that they like to see, companies that'll continue to top up versus taking a one-time stake, because 9% stake over time could get diluted down. Where do you stand on that debate as far as how strategic partnerships are most advantageous, I guess, from both sides, to the major or to the junior?
Yeah, well, I think in short, it's very much case by case. I should also note that it's a little bit of a false choice, because in the case of Centerra, for Kennerland, for instance, we've seen them take both a strategic equity stake, but also get active on the project level. Originally with the Hunter project, and more recently in recent months, a handful of projects in northwestern Ontario. So sometimes a strategic stake can lead to project level investments, and who knows, we may see the same for Headwater or for Azimut or for Midland. So I think investors should keep their eyes to that. In terms of the debate, one or the other, I think it depends on the junior's cash position. And I also think it depends on the premium or lack thereof that the strategic is willing to pay. So if the junior's already fully cashed up with no need for capital for a 3+ year time period, then as an investor, I would be much more interested in a project level stake. But conversely, if the company only has a year or year and a half of runway, and the strategic stake could ultimately lead to project level investments, Like I think it's something that should be taken seriously. And then there's also just the validation that comes, from a 20, 30, 50 million market capper, taking on money from a group of Centerra's stature and size. So I also think it helps more broadly from a cost of capital perspective as well.
Matt, when we're talking about these exploration companies, a lot of explorers have also been running. This summer was a great time for these juniors. Even without news being released, we are in that environment where stocks are running ahead of drill results outside of these companies having, I guess, major backers or large companies supporting them. What do you do? What are you looking for when you see this environment where, again, juniors are running without drill results? Good drill results are still pushing stocks higher, but what do you do in your portfolio when you see those kind of movements?
Take profits. Any time that you've invested in a company with a specific thesis for a drill program, and you see that company climb 75, 100% in share price ahead of results, that's a great opportunity to de-risk. Whether that's selling, a portion of your percentage position, whether that's taking your entire cost basis off the table, that's kind of an individual decision and can be done on a case-by-case basis. But I think anytime you see a substantial re-rate purely based on hype, it is prudent to be doing at least some selling. I'll also just say from a general sense, and we've done plenty of these podcasts over the years, you guys will be well aware, like we've been fully deployed all of 2024 and, through the first 5 months of 2025. So a good 17 months of basically having a 0 or 1% cash position. I should note that we've been taking profits in quite a few of our names and liquidating a couple as well, where I don't think the investment thesis has played out. So the fund is, currently at around a 12% cash position. And, we're well on our way to the mid or high teens. So I think it is prudent, when the going is good. You don't have to throw in the towel on the whole sector by any means, but when the going is good, take some money off the table, stash that away for a rainy day, because nothing goes up forever, and there will be better buying opportunities, whether it's later this year or sometime next. I'm pretty confident in that, at least for the gold and silver names in particular. You could maybe make a different argument for kind of the rest of the commodity complex, which I think does have some catching up to do.
Matt, I think this topic is so fascinating. There are so many podcasts out there, not just our channel, but so many channels talking about when to buy, always time to buy, always a sector to buy, but so few that talk about when to pull profits, when to sell, when to go to cash. And what we see during big panics, like when we saw the April tariff tantrums, or if you think back to the pandemic crash of 2020 or the great financial crisis, a lot of people go to cash at the bottom of a cycle in a panic move, and they raise cash at the totally wrong time. Very few people talk about raising cash when times are good, and it's a delicate balance of when to hold on to the winners and let your winners run and when to start scaling out. But when you raise that cash, so in your case, you're going from a 1% to a 12% cash position, as you say, you can wait for the rainy day and average back into some positions. Do you find yourself having the propensity to get new positions with that cash, or to go back in positions you had that you scaled out of and have now pulled back to a better price? Or are you more interested in reloading the boat on a horse that's been winning for you and you think it can keep winning? Or are you more propensity to start new positions with that cash that you've raised?
Yeah, it's a great question. I mean, for myself specifically, it's a mix. It'll really depend on a case-by-case basis. I'm obviously more comfortable with the names that we own within the portfolio. I own them for a reason. And so if in a panic-like scenario, we have an opportunity to average down on our cost basis, and I believe, firmly that the investment thesis remains very much intact, that is generally going to be my preference. But I also think in times of fear and times of panic, that you can also look to the very high quality names that maybe ran away from you in the previous up move, and that you wanted to own, but perhaps didn't think it made sense from a valuation perspective. So you can kind of shift your portfolio to quality when everything else is on sale. So in terms of the new names that would be coming in, it's really the higher quality companies that I wish we'd owned for the previous run up, but didn't for one reason or another. And now's our opportunity to take a stake settle in and hopefully profit when the market inevitably turns.
All right, time to wrap it up here, Matt. Thank you for your insights. Look, again, it continues to be a very good environment for especially precious metals investors, but you've outlined some opportunities also in the copper space. And right now, yes, if you are harvesting some of those gains, which might not be a horrible idea, just have a plan of what you're going to do with that. And everything is more or less a case by case basis. Again, Matt Geiger, managing partner at MJG Capital. Click the link in the show notes to learn more about Matt's fund and MJG Capital. Matt, thank you as always for your time. It's great having you on the show. And everyone, stick around. We're going to be right back, shifting our focus to the oil and natural gas sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, now shifting our focus over to the energy sector, mostly oil and natural gas, with Dan Steffens. Dan is the president of the Energy Prospectus Group. And Dan, I don't want to spend too much time on the oil or natural gas prices because, quite frankly, those continue to be extremely boring in my eyes. Crude, yes, it's risen a little bit up to, as we're recording this, around $65 a barrel, but I think you can still make the argument looking at a longer term chart that it's still in just a gradual downtrend. And natural gas, as we're recording this, right around $3, which again, this year, range bound to down again. So I do want to get more into some of the stocks and what stocks are maybe garnering a bit more attention, what the companies can do to get some more interest in those stocks. But quick comment, oil and natural gas. Dan, is anything going to change in the near term in the pricing environment that, again, has been boring?
Well, I think oil there's so many geopolitical risk factors. I think when people realize that OPEC Plus raising their quotas is not really increasing production or increasing their exports, they just raise their quotas and half the countries can't produce up their quota. But the other thing, I mean, this war in Ukraine is not ending anytime soon. I think it only ends after there's a very long ceasefire period they can both agree to. But as of right now, there doesn't seem anything. And, on Tuesday at the UN, Trump basically just said, Europe, it's tag you're it, and we'll sell you weapons. We're not going to give you weapons. We'll sell you weapons, and you should give them to Ukraine if you think they can win, and let them try to win their deal back. So that doesn't sound like me anything. And then you got Iran still talking about wanting to keep enriching their uranium. I don't think that's settled. And the U.S. has positioned several warships off the coast of Venezuela. So what's going to happen there? There's just so much unknowns. But IEA, like 2 weeks ago, IEA puts out a report. It's almost like a total reversal. I mean, this is the same organization, the super left political organization, IEA, that's been telling people last year that we were at peak demand and you should stop investing in oil projects. Now they're saying if we don't spend at least $600 billion a year, we're not going to be able to meet future demand. So I don't know. There's a lot going on, and it just has to work its way through. But I do think there's some special situations in the individual companies that we probably should talk about.
Well, Dan, let's go there next, because there are companies that have growth catalyst, or they have something in their pipeline of projects that they can develop more wells, or there's some acquisitions we can get into. Let's maybe kick it off with a company we were talking about off mic, and that is Crescent Energy under the ticker CRGY, and their acquisition of Vital. And basically, this gives them more run room, and we're in that interesting period before the deal closes and before analysts have a couple of quarters to do the math. So give us your upside case here on this larger pro forma company.
Yeah, for one thing, I've been following both of these companies for quite a while. Crescent Energy jumped onto my radar screen when they bought out Lone Star Resources, which I really like that deal. They got some big money behind that company. KKR is a big private equity firm that's kind of behind that company, but also I've been following Vital, and I've been thinking that Vital is grossly undervalued for a long time. And I think part of it is it's headquartered in Tulsa, and I don't know why, but the Tulsa-based companies don't ever get much love from the Wall Street gang. Maybe nobody wants to travel to Tulsa or something. Anyway, but one of my most highly respected energy analysts, Neil Dingman, put out a new report here on Monday, and he had Crescent Energy at the top of the list of companies that he's rating now as outperform. And it is free cash flow positive. And the good thing, this is a big deal by the way, this deal is valued at $3 billion it's a stock for stock deal, but they're assuming all the debt of Vital. But when it's combined, it's going to have a decent balance sheet. They're going to immediately sell, they say, $1 billion worth of non-core assets. They'll even shore that up more. They've already got those data rooms and everything ready to go. And it looks really good. But post-closing, it will be the ninth largest, based on production, the ninth largest upstream oil and gas company in the United States. That's a pretty big deal. I mean, you're up in there with, at the heels of people like Devon and, Matador and stuff like that are in the, top 10. So it's going to get this stock on a lot of analysts' radar screens. But I expect the merger to close in November. When it closes, it should have production of about 400,000 BOE per day and kind of balanced. And the good thing is, or I guess a good thing, but Vital, which I followed for a long time, they were from the end of the second quarter through the end of through October, they were going to complete about 38 new wells. They were running a bunch of rigs, and then they were just going to totally stop their drilling program, which was kind of interesting. So that tells me that this sale's been, going on. This negotiation's been going on for a while. So they should have all those wells online by the end of October. And what's really good, they've got over 90% of their oil hedged at good prices above the current oil price through the end of the year. So there's not a lot of price risk. And Vital doesn't pay a dividend. So the benefit, all that extra cash flow from that new production will go into the new Crescent, the new pro forma company. It's not going out the door to pay dividends. So they're going to get all the benefit of that cash. But it closed yesterday at $9.09. First call's price target is $15. So you got about, 50, 60% upside if it just gets a first call price target. My valuation of Crescent Energy as a standalone company is $22 a share. Post-merger, and I have a detailed pro forma forecast model for it, is $24.50. And the stock's trading under 10. I mean, this is a really good company, and it pays a nice dividend. And it's said it's definitely going to keep paying the dividend. Dividend yield right now is 5.2 or 5.3% on their dividend, 48 cents a year, 12 cents a quarter. But it's got a lot of running room out there. And Vital was a pure Permian Basin company. So Crescent Energy was South Texas, the Eagle Ford primarily, and you went to basin. So this gives them a third core area. And Vital has a pretty good acreage position in there. So they're going to have three core areas, a lot of running room. They can, I think what they'll do though, they'll pull it back, the amount of rigs run. I don't think they're going to jump into the Permian and start drill crazy. And, usually when you have I did this at Hess. So usually when you have a merger of this size, it takes a while for you to figure out, all the people you're going to keep, get all the records set up in your systems and everything, get everything lined out, because it is a big deal. And I really like it. And I think the Wall Street gang will, especially if oil prices firm up. But it's got a lot of gas and got a lot of NGLs too. So it's a nice split. Yeah, if any of your listeners want to, ask me for it, I'll send them my detailed report on the company if they want it.
Okay, just send us an email if you want that report. But Dan, to that point of, let's say energy prices don't go up from here, this acquisition or merger, what I'm hearing is, yes, there's a lot hedged here. So there's that safety aspect. They can sell some non-core assets to build up some cash. Is this, in your eyes, more of a defensive play to protect the maybe merged company in case energy prices don't go anywhere? Or is this more about growth once everything gets sorted out?
Yeah, it's growth. Everything once gets sorted out. I think them selling, if they can sell those assets for $1 billion and their balance sheet's going to be in real good shape by the end of the year if they can do that. And then they'll have, a drilling program and stuff. And they've been pretty, as a standalone company, they've been pretty aggressive. So And they're backed. They're backed by KKR, which they got a big company behind them. So I don't think they have any near-term cash problems. And my valuation for next year is based on $65 oil for the whole year. And, I think, yeah, could oil flop around in the low 60s for a while, but sooner or later, because U.S. production is going to peak in December. And after that, you're going to see a decline in U.S. production. We are not completing enough wells. That is their current forecast, peaking in December. And it always declines in the first quarter just because of weather-related issue. But I think once the world, there's other stuff coming on in Guyana. You hear people talk about all that stuff. And all that's doing is replacing the continuous decline in the oil market, in the oil production. I mean, all oil wells start depleting within months after they're online. So you got to keep spending money and keep completing new wells.
Well, Dan, we'll definitely keep our eyes peeled for the pro forma post-merger metrics on how this company continues to grow, but they do have a nice mix. They do have those hedges in place. And it is a nice name to do some due diligence on. Well, really either name you could get in before the merger and let the company merge into the new combined entity. Another company we've talked about in the past, but it's definitely worth revisiting, is Diamondback Energy. Traded on the ticker FANG. We've also talked about their spin-out royalty company, Viper Energy, Venom, so they have that snake theme, but this is a market darling. This is a company that has an incredibly profitable business, but they've announced some potential to do a mega power project soon. So I'd love you to dive into that and just an overview of Diamondback Energy.
Yeah, they on their last conference call, they kind of mentioned a power deal. And what's happening is they're building their own power plants, and they're going to sell that power to either AI data centers or sell it into the grid. Another Riley Exploration Permian is doing that, but Devon, if Diamondback does it, they're going to be able to do it on a big scale. And I tell you, everything I'm seeing on these AI data centers is, I didn't even know this. There's two really big ones being built in Louisiana right now. And I didn't even know anything. I didn't know that until yesterday. But there's several being built in Texas, and they're just going to take advantage of that cheap gas out in West Texas as long as they can. But that would be a great deal for them because they've been getting really crappy prices for their gas out there. And what they're doing is they turned gas they were giving away for like $1.25 or something, and turned it into electricity, which they can sell into the grid. So it's basically like you're converting gas into electricity and selling it for 3 times more than you'd be able to sell it as just gas. So it's good. And they produce a lot. I mean, what's unbelievable to me is Diamondback, as of yesterday, was trading below book value. That is insane to me. It pays a decent dividend. It's got buyback programs. It's got one of the highest free cash flow per barrel of the entire industry. It's undoubtedly got the most tier 1 core acreage in the Permian. I mean, there's just no reason whatsoever. And I think if there's just a change, a paradigm shift, let's say, and the Wall Street gang says, hey, you know what? Now it's okay to start investing in oil and gas again. Diamondback will be a must-own stock for every portfolio manager. It's that good, and with an unbelievably strong track record. And if you got Exxon or Chevron or somebody wanting to make a big deal, Diamondback will definitely be on their buy list.
With these power projects, because they're just being announced, they do take time to build out. What do you watch for to make sure that everything's going according to plan? And when do you see that the market starts reacting to some of this news? Because right now, Diamondback, it's really just gone sideways for most of this year.
Yeah, it's amazing to me. I mean, maybe they could pay more dividends or something. But if you really want dividends, the thing you do is buy Viper. They control Viper, and they drop down a whole bunch of their mineral interest into Viper. So if you're looking for dividends, and Viper I love. In fact, Dingman announced in that same report, he put an outperform on Viper as well. But Diamondback's more of the growth story, and as a screaming takeover target at this price, if you ask me. But if you've never looked at it, I can tell you start digging into that one. It is a first-class outfit with a really strong track record. I mean, I've been following it literally for 10 or 12 years, and its growth has just been phenomenal.
Well, we'll definitely keep following along with Diamondback and Viper to see how things progress. But another company you've highlighted as one that has some potential to grow is Devon Energy, traded under the ticker DVN. Now, I think Dingman also noted that in his recent publication that you're talking about. So give us the skinny here, Dan. Why Devon Energy? What's the growth on tap?
Well, it has one of the highest rates of return when you look at its dividend plus its stock buybacks. And if you add those two together, it's got one of the better ones. I mean, it's buying its stock back in chunks. And the stock buybacks don't really seem to get as much credit as they should. But when you think about it, you keep reducing the amount of shares outstanding and the net value per share, really goes up. So you do it. And they're also highly respected as far as their technology and everything they're doing. They got some of the lowest operating expenses and stuff, and they're just doing really good stuff. I actually, when I left Tesla, I interviewed with them in Houston. They had a big office in Houston, but their main office is in Oklahoma City. And anyway, the guy I was interviewing with was 10 years younger than me, so I didn't think he was gonna hire me. So who knows? But anyway, it's closed recently around, let's say it's around 35 now. My valuation is $50, so I think there's a good $10 or $15 up. And the first call price target is 45. So other analysts agree with me that this thing's undervalued. Now it's like we were saying, Crescent will have production of 400,000. Devon has production of 845,000. It's one of the top 3 or 4 largest, highest producing independents in the country. So it's a big company. I like its production split, and it's not all in the Permian Basin. It has some Permian Basin, is Oklahoma, it has Uinta Bay, it has other ones too. So its production mix is 46% crude oil, 27.5% natural gas, and 26.5% NGL. So if you read the EIA's last short-term energy outlook, one part of the long report on that is their discussion that this next year in 2026, they see oil and gas like totally separating from value standpoint. And they're predicting that the natural gas price goes up, where they're still predicting that the oil price goes down. I don't really agree with that analysis, but they've got a very aggressive. They think natural gas in the U.S. by the end of next year will be $5.30 based on their formula when you get to December. And if you put $5 into like Devon for their gas price, it's really strong. But it's got this year it's generating 2.7 billion in free cash flow this year, pretty much locked in by their hedging program and everything. And I'm using pretty conservative things in my forecast model. 2.8% dividend yield and a very aggressive stock buyback program underway. They really believe their stock is grossly undervalued.
Curious your thoughts on that. The dividend yield, yeah, under 3%, but a big stock buyback program. But again, this stock hasn't gone anywhere in a number of months, even dating back to late 2024. Would you like to see them pay a little bit more in terms of dividend to return some money to shareholders, or do you think that stock buyback program is what's needed to hold the stock here?
Well, the reason these companies do the high stock program, their major shareholders want capital gains. They don't want ordinary income of dividends. That's why they do the stock buyback programs. Now, but I don't think you're getting the benefit of that in the stock price yet. But if oil prices and gas prices do firm up and their year-end reserve reports show a lot more value for their proven reserves, then that's where you're going to get that benefit on a per share basis. So, and I like it. I personally like when I think stock buyback programs significantly reduces your risk because what they'll do, they go into the market when the stock's down and they buy it. So they set the floor on the stock price. So it significantly reduces the risk if they have stock buyback programs.
Well, Dan, I think a lot of people, if they dig into it under the hood, can understand the rationale for the stock buyback, not just from making the company more valuable per share, but also, like Corey was saying, kind of backstopping the valuation of the company as far as the share price level. But when you talk to most retail investors, they get into oil and gas stocks because of the dividends. So while the corporates may like the buybacks, most investors, when you talk to them about, hey, if you're going to get into a dividend-paying sector, you can get into the utilities or you can get into the energy sector. Wouldn't it behoove a lot of these companies to beef up the dividends with that kind of interest from retail?
Yeah, I mean, I like them. Most of my money is invested in our high yield dividend portfolio, which has a yield of like 7.5%, 8%. So that's where I like to put my money. Yeah, I've got a few of these small caps that don't. I'm still keeping interest in them because I think they got a lot of upside. But I'm moving more and more of my money into dividend paying stocks, and there's a lot of good ones out there. A lot of good ones. The midstream companies are great, but we've got some real good companies that pay monthly dividends in our high yield portfolio. Hey, a dividend one, you want to talk? I got one more here on my list to talk about today. That's Northern Oil and Gas. And they do pay a really nice dividend, 6.8% dividend yield. The stock's at about $27 today. My valuation is 44. First call's price target is 33.30. So you got $6, $7 at least upside in the share price. Now, it's unique in that it is the largest publicly traded non-op company. They do not operate any of their properties. So they will go in and they're with Vital. They went in on a deal with Vital. They took 20% of it. Vital took 80% of it. They went into a deal with SM Energy, and really, really high quality company. SM Energy, where they took 20% and SM took the other 80%. And they're very well known. They've grown. I sort of followed this thing, 15 years ago, at the very start of EPG, 20 years ago, probably then, when it was really small, and you start seeing it, and they were really focused on the Bakken at that time. And you'd look at everybody's deal, and they were in their wells like for 5 or 10%. And all these Bakken companies, they were 5% working interest owners. And they have just grown and grown and grown. And through some very, like Dingman says, 15 in a row accretive acquisitions they've made since 2021. What a great time to be a buyer was during that stage of the pandemic. And they got some stuff at really good prices, and now it's worth a lot. I think it's a screaming buy at this price for the dividend.
Dan, I'm curious, with your price targets here, can you give us some insights on what plays into that in terms of time frame, when you think that these valuations, these price targets could be hit, and how you factor in different, I guess, energy prices, oil and natural gas prices into these targets, just so we can get a better idea of your price targets, which are higher than where the shares are trading, when we could expect that to come to fruition.
Well, I mean, everybody's price target is going to be a little bit higher, but it's all based on what, commodity prices you use in deal. So I base mine on what I believe will be fair multiples. Now, the multiples are so much lower than they used to be. You see profitable companies that are free cash flow positive and they're trading for 3 times cash flow. That's insane. When I was at Hess, I had an M&A team at Hess, and we were always looking at public companies for takeover targets. I ended up closing on 3 or 4 of them for like 3.5 billion, which in today's dollars would be like 8 billion. But we're looking to acquire companies that had a lot of development acreage. I call it running room. I just think if you got a company and they're great production, they've been having production growth year after year, but they don't have any more drilling locations. They've drilled up all their acreage. So they're going to have to go buy more, or maybe pay a premium, or you're going to sell the company. You have to have running room in this. That's why you see the biggies like Exxon and stuff out buying companies, because there's no more open acreage in the Permian. They have to buy another company. They can't just go send out landmen to lease it up. But I look at the quality of the balance sheet. I look at not only their debt level, but what is the debt? If it's all a revolver that can be called, or if it's all on debt that's got all these covenants that look like they're going to break the covenants, that's a problem. That's what throws a lot of the littler companies into bankruptcy. Their ratios go out of compliance with their covenants. And can they just service the debt? And so that's what you look at EBITDA. So if the EBITDA is earnings before taxes, interest, and everything, that tells you how much money do they have to service the debt. So if that's no problem, if they got more EBITDA than above their taxes or their interest rate, then that's no problem whatsoever for them. But it's just running room. And so right now, all these companies, and then also their hedging program, because I was looking at Magnolia today. Magnolia looks really good, but they don't have any of their production hedged. So I lowered their valuation multiple. I mean, it really looks good. Plays nice dividends, stock buyback programs, got a ton of nice running room. 8 to 10% growth just locked in for years with the acreage that they have, but they haven't hedged any, and I don't know why. At a minimum, these companies should all be using costless collars. You can go out right now, and let's say that the price is 65. You can go put on collars with $60 floors and $70 or $72 ceilings on them. What the heck? And then at least you got your downside. You should be definitely hedging enough to lock in the cash flow you need to cover your debt payments. That's a minimum for these smaller companies. But the ones we're talking about today, they're really big companies, though, so they're in pretty good shape. And then it depends too. When you look at somebody like Crescent Energy, and I think people really don't look at this enough. Look at who some of their major shareholders are. If you got great shareholders that are deep pocket shareholders, they're going to support you. They'll put in more money for stock or something like that. But anyway, but none of them. I'm not valuing any of these companies at more than 6 times cash flow, and that would be even the super great companies. Let me see what I'm using here on Diamondback just for grins. Okay, on Diamondback, I am using 6 times estimated cash flow for 2025 and 2026 annualized. That's how I get to it. And they are so strong financially, but with them, they deserve that because of the quality of their acreage. I mean, you hear about the tier 1 acreage in the Permian being all drilled up and running out of it. Not for them. They got years and years of drilling inventory out there, which makes them a really attractive takeover target.
Well, Dan, in lieu of all the different factors we've talked about that you look at for valuations, whether it's two companies coming together in the new pro forma company, whether it's the growth on tap for 2025 and 2026 and the multiplier you apply to that, whether it's the potential and torque they have to higher energy prices, I think a lot of investors have limited capital and they can only make a few choices. So if I could tie you down, I know you're diversified across the whole sector, but if I could tie you down, would you be more interested in nat gas or oil focus? And would you be more interested in growth from the small to mid caps or safety and income from the larger companies?
See, I think it's the perfect time to switch more of your portfolio to gas. Gas is down just because we've had a couple storage reports that are a little bit above the 5-year average. So I was on a podcast yesterday with U.S. Energy Development, and I pointed out, I said, so people are going, oh, storage is 200 BCF above the 5-year average now. Last winter, which was a mild winter, we had 4 weeks where we had draws from storage more than 100 BCF a day, BCF above the 5-year average. 4 of them. And that was a mild winter. And it got mild. We were having increases in storage during March. Usually the draws last through March. I'm just telling you right now, if we have a La Nina winter, and that's the prediction right now, you can get that usually starts with a colder start to the winter. And colder up where you guys live in Vancouver and more snow and everything. And you can get a couple of cold weeks in December and that can wipe out. And think about this. This first quarter coming up, we're going to have 4 or 5 BCF more of LNG exports. Let's just say it's 5, which it should be when they're all online. If it's 5 BCF higher, that's 35 a week. You add 35 a BCF bigger draw every week compared to last year, we're going to be way below the 5-year average by the end of January. The way I look at it, and these projects are coming online. They are online and they are fast tracking these. I got from now until the end of 2027, so 2.5 years. You're looking at more than 8 BCF per day of additional LNG exports. That does not include the AI data center stuff. That does not include the two BCF a day increase in exports of Mexico during that time period. It's looking really strong for gas. So I right now recommend you switch over to gas. Look at the production mix of each company. And then you can also look at their hedging programs. Have they started to lock in some of these higher prices? Because right now, today, the January contract for gas right now that you can lock in is over $4 today. And you could do a swap right now at $4.
Dan, I'm just curious because a lot of these charts that we're looking at, I think you could argue mostly range-bound trading within these stocks. Yes, they're paying dividends, but again, on the capital gains front, and maybe this is just the problem of oil and natural gas not really doing much, but any stocks out there that you're following that are just blowing it out of the water, the market is actually noticing, and their stocks are breaking out to higher levels?
No, we talked about in play last week. I cannot understand why people don't realize the importance of Delek becoming their major shareholder. That is more significant than the fabulous second quarter results. The company is paying like a 7 or 8% dividend yield. It's got tremendous growth potential, and it's just not yet getting. I mean, none of the Canadians are really getting the attention they should. But that's one that I really like now, and I've shifted more money into it. But I personally am and my portfolio has done quite well this year because I've invested in stocks that pay 7-8% dividend yield. So the dividend yield's making up for okay, they're trading sideways, but I'm getting these great dividends. They're just building up in the portfolio. So what the hell?
Well, and there's the side of it. Yeah, just wondering if there's anybody out there that's really catching your attention. Yes, Employ has done very well. The last couple of weeks it's moved sideways, but again, it has really run since May, I believe. So, look, I'm sure there are some other names out there, but right now it does sound like the type of environment where you can still be buying a lot of these companies as they're not breaking out, not feel like you're chasing them higher, and hopefully you get that better pricing environment in terms of oil and natural gas prices that continue to drive these stocks. But sounds like there's still a lot of M&A activity happening.
Yeah, there is. And I think there's going to be. I think you're going to see more and more M&A activity. And see, a lot of companies do M&A activity near the end of the year because they want to get that deal closed before year end so they can include it in their year end reserves. That always has something to do with it.
All right. Well, Dan, we got to wrap it up here. Again, Dan Steffens, the president of the Energy Prospectus Group. Everyone, thanks for tuning into this weekend show. Hope you found it valuable. Our focus on metals in the first half and energy on the back half. Metal sectors sure are running. Maybe some of that money will start to rotate into the energy sector sooner rather than later, but always opportunities in both of these markets. Everyone, again, thanks for tuning into this weekend show. I hope you have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.